Hello, and welcome to Innovation Women Speak webinar series. My name is Mary Beth Russo, and I'm sitting in for Bobby today. For those of you who are new to Innovation Women is a visibility bureau for entrepreneurial, technical, and innovative women. We connect female speakers with speaking opportunities, and we connect event managers with female speakers. Our mission is to help women build their brand and advance their career while eliminating the all-male, all-stale panels that we see so often. Unlike a traditional speakers bureau, when you join Innovation Women, you get all of this that's showing on your slide today. You get a lot of social media amplification, promotion, you get speaking invitations, and a weekly list of calls for speakers. You get author promotion. If you have a book, we promote you in your book. We shout out a lot of your speaking opportunities where you're speaking, so we promote you unlike most traditional speakers bureaus. Feel free to learn more about Innovation Women by signing up for our newsletter. If you go to our website, innovationwomen.com, you can sign up for the newsletter or use the bit.ly link shown on your screen, or you can text INNO to 22828. Before I turn it over to our guest speaker today, I'd like to just review some logistics which will help you with your experience during the webinar. Oh, and a 20% discount. I just wanted to mention that. If you sign up before the midnight tonight using the promotion code IWWebinar, all caps, you'll get 20% off your first year until midnight tonight. So the logistics I wanted to review with you are showing you how to navigate through your screen. What you see here is an annotated version of your screen. Below the video viewing window, there are tabs, and the tab that's default that shows is for asking questions. You can type in a question at any point during the program, and we'll answer it accordingly. The Vote tab is where you're going to see the polls that we're about to ask you, and you can answer the polls using this tab. The tab called Rate This enables you to rate the webinar and provide feedback if you'd like. We do read all the feedback and adjust our program when listeners request something, so feel free to provide feedback and rate the webinar. If you need any audio help, feel free to click on the Help button at the bottom of the screen. But if you are using your phone to dial in, you'll need to mute your computer audio. So before I turn it over to Kristen, we have a little bit of a promo for our next webinar coming up in 2 weeks, and it proves to be very exciting, very interesting topic. Candace Hughes will be talking about, are we ready for a totally different healthcare? Wearables and mobile move health into your home. We will push out a link to you to register after the end of the webinar. Be sure to register for that. That's on April 3rd, 12 o'clock Eastern Time. And I'm going to introduce Kristen today, our special guest. Kristen is COO of Catch. Catch is a personal portable benefits platform for freelancers, contractors, and those who don't get benefits from an employer. Catch offers one place to set up and manage tax withholding, retirement, and health insurance. Kristen will go through with you today how can we create a financial safety net and how can we do this easier. So before we start with Kristen, I'm going to send out a poll, and the poll is, the question is, What type of work do you do? The answers, you will see the poll at the bottom of your viewing window. And the answers are full-time W-2 work, part-time W-2 work, full-time 1099 work, part-time 1099 work, mix of W-2 and 1099 work. So I'll give you a minute to fill that question out, and then we will move on to the next poll. Okay, we're getting some answers in. We have a mixture of 1099 and W-2 employees, and also a mixture of W-2 and 1099s. Great. Thank you for answering that. I'm going to move to the next poll. And the poll is, do you get health insurance and retirement benefits from your employer? The answers are yes, no, or I'm not sure. You should see that poll showing up as well at the same spot you voted for the other question. Do you get health insurance and retirement benefits from your employer? I'll leave the poll up for just another few seconds. Great. Looks like the majority do get health insurance and retirement benefits. Thank you for answering that question. So I'm going to close the poll, and I'm going to turn it over to Kristen. And feel free again to ask any questions during the presentation, and we will answer them following Kristen's presentation. Thank you.
Great. Thank you, Mary Beth. I'm so excited to be here today. So we're going to talk a little bit about the savings crisis and behavioral economics, but as a bit of context, Mary Beth introduced me a little bit. My background involves some work with building financial services and technology for the underserved, as well as trying to create products that help make a better safety net. So we're going to talk a little bit about the fundamentals of what a safety net is comprised of and what that means, how we think about it at Catch, as well as what behavioral economics is. Maybe it's a term you've heard something about, but maybe aren't that familiar with. So we'll talk about some examples and then how we can use those concepts to build a better savings product for more people. So as Mary Beth mentioned, Catch is a portable benefits platform. So what we've seen in the last 50 years is that the way people work is changing, and the number of people who are not covered by traditional benefits is growing. So whether that's through full-time freelance work or through various part-time jobs or a mix of 1099 and W-2 work, the existing benefit system has been very much built around a traditional W-2 employer-employee relationship. So we're trying to build a solution to that by pulling together tax withholding, retirement, health insurance for independence, sort of all in one place. So first, to get started, let's talk a little bit about what financial security is. I think the interesting thing about this concept is that for the very, very wealthy, as well as those who are probably the least wealthy, the answer is often the same, and that's just how much money you have. When you're very wealthy, you often think about like financial security is just like how much money, like how much wealth do you have, how many assets. And when you have no money, you often think about it the same way. But actually, for the majority of people in the middle, financial stability, or financial security rather, is actually much more closely related to financial stability. So when we think about this at Catch, we talk about a couple different things. So first, the first component of financial security is savings. So the ability to have liquid money that's available short term that you sort of have as a fraction of the income that you earn. The second pillar is really investment, so the ability to have part of your money working for you and growing into the future. The third component is insurance. So this idea that you have sort of this catastrophic protection against things that you may not be able to cover with your savings and investment. And the last pillar is credit, the idea that you can flush liquidity and capital into your finances in the medium term. So when we talk about financial security, basically it's having enough of each pillar when you need it. So it can look a little bit different for different people, but these are the four components that we talk about when we think about financial security. And for the purposes of this webinar, we're going to be focused on those top two ones. So savings and investment is where we'll spend most of our time, but I think you could do an equally compelling conversation around insurance and credit as well. So the first question, why is saving money important? I think this is something that we've all been told we need to do from the time we're very, very small. But the reason why it's important to save money is actually two reasons. One, it's because we can't predict the future and we have no idea what's going to happen to us. And so having savings allows us to protect against the unknown. And the second reason is that most of us don't want to work forever. We may not think of retirement in a traditional sense, but there's certainly a world in which most of us would like to not have to be constantly working. And so saving money is important for the future for that reason as well. So I mentioned it in the title, maybe you've heard this before, but we are in a savings crisis right now. People don't have enough money saved. And so before we get into why that is, I wanted to talk a little bit about what the actual numbers are. So for a little bit of context, in 1970, the family savings rate was about 12% of income, meaning families were saving, 12 cents on every dollar that they made. For comparison, right now, that percentage is about 3%. So just the total amount that's being saved by families is far, far lower than it used to be. A slightly different way to think about the size of this problem is related to those two first buckets that we talked about, savings and investment. There's a number that the Federal Reserve calculates every year on economic stability, which is a $400 emergency. So there's a lot of conversation around, like, how would you cover a $400 emergency? That might be a small medical procedure or your car breaking down or just, a new refrigerator. And right now, the results are showing that about 40% of Americans don't have a way to come up with $400, and that in order to come up with that money, they would either have to borrow or sell something. That's a very small amount of liquidity, and that's a fairly large percentage of people who would struggle to come up with that amount. The second number that's important there is that 70% of Americans would struggle with a $1,000 emergency. So think of that as a slightly larger medical procedure or, maybe needing a new form of transportation. Right now, 7 out of 10 Americans don't have an ability to come up with $1,000 in savings. On the retirement side, things are equally dire. Right now, 21% of Americans have $0 saved for their retirement, and that's sort of across age ranges. But that's 1 in 5 people who don't have anything but a side, including about 10% of people who are over the age of 50. When you look at the number of $5,000 set aside, 1 in 3 people have less than that. So in terms of the amount of money that you need to retire, the general recommendation varies a little bit based on where you live and how much income you've made, but a number that a lot of people use is $1 million. And the number of people who have $1 million saved for retirement, unfortunately, is 0.04% right now. So when you look at these numbers, you can sort of see that the situation is pretty dire and that people really don't have enough money set aside. So the question is, why aren't we saving more? We used to save more and we're not now. So when we look at why that might be happening, I thought we'd start with 2 opinions of people who have ideas on why this might be. The first is Senator Chuck Grassley. He said, quote, "Americans are just spending every darn penny they have, whether it's on booze or women or movies." So that's one hypothesis, is that Americans are spending money on consumable goods. Not quite sure what he means by women, but we'll think about that as an option. And then we have another reason from Tim Gurner, who's an Australian millionaire, who said that it is because of avocado toast and lattes. So those are some interesting hypotheses. Certainly things that people are thinking is why we're not saving enough money. But I have to say, personally, having done a bit of research, I would say that booze and women and movies and avocados and coffee are actually not the reason that we are in a savings crisis right now. But there actually are a lot of very real reasons that's making it more difficult, and it's not to just blame it on a generational difference. So let's talk a little bit about what those items might be and why it's making it hard to save. So the first is stagnant income. Most people know that for the last 30 years, income has been fairly stagnant, but I really like this graph here. On the y-axis, you have the growth of income, so between 0 and about 4%. And on the x-axis, we're talking about what percentage of income you earn. So that 99%, everything higher than that is the 1%. So what you're seeing here is that the green line represents 1980. And in 1980, the highest growth in income was actually coming at the lowest earning percentage of the population. So for those earning the bottom 10% of income, they were earning about additional 4% each year. The red line, unfortunately, is 2015. So in 2015, those at the bottom end of the income spectrum, their income isn't growing at all. And those in the 1% are actually growing their income annually pretty significantly. So one reason is that for the majority of Americans, their money is growing less. The second reason is that prices have increased on a lot of really key items that people absolutely just have to pay for. So since the 1970s, the cost for housing has increased about 74%. The cost for health, both insurance and related care, has increased about 76%. And the cost for education, particularly higher education, has increased 100%. Obviously, those numbers are far greater than the cost or the price of inflation, and so families are having to spend more money on the same sorts of things. And then the final major contributing factor here is that savings are more expensive now, which means that you're basically earning less money on what you put aside. So to purchase a 5-year CD in 1978, you would earn 12% on that. So a CD is a certificate of deposit, basically allows you to put money aside in a very safe vehicle, and 12% is a fairly good return on that. I think, most of us look at the stock market and shoot for 7 or 8%. Well, right now, a 5-year CD returns about 3%. So there's an interesting correlation in those numbers. If you look at the savings rate from 1978 to now, you also see that those numbers are very related. So we're not as incentivized to put money into savings accounts. So what is the impact of all of this, of not having enough savings? We talked about it a little bit at the beginning, but to think about it in two different ways. The first is what impact does this have on a family, and how does that change how they operate? So there are a lot of different impacts. I think most of these we all intuitively understand. Not having enough money saved can lead to increasing volatility and insecurity. I really like this visual of this sort of squiggly line that gets bigger and bigger and more amplified, because I think you can think about this a lot of what families' finances look like when they don't have enough savings. So one small emergency can cause them to take out a small loan, which puts them back above the line, and then those effects can sort of compound over time, and each emergency becomes more and more dramatic to the point where people aren't able to, afford their transportation and not able to get to work, not able to provide things for their children, and so it leads to a dangerous level of debt for individual families. For society, the big thing that you see is that it can lead to increasing inequality, whereas the rich keep getting richer and the poor keep getting poorer. And we've all heard that before, but again, this visual is an interesting way of saying we can often talk about the middle and say, okay, well, the middle income is staying about the same or is increasing a small amount. But when you look at both ends of the spectrum, the difficulty can be for those people who are below the line. Things are getting much worse for them much more quickly. And when you have greater inequality in a society, you can have things like more instability society-wide, including things like worse health outcomes. So I think an interesting statistic or fact that most people don't know is that when a society is more unequal, health outcomes suffer for everyone, even the very, very rich. So if you were to think about that and say, as our society becomes more unequal, even Bill Gates is less likely to be healthy. It's a really important way to think about the importance of having a less unequal society. So the question is, why can't we fix it? If we know this is a problem and we can sort of see the effects that have come into play, why haven't we found an easier way to just incentivize people to save money? And there are a lot of reasons, but I want to focus on three of them. So the first is technology and self-control, which is really that media short-term rewards are being incentivized, and sort of our basic brain structure often prioritizes an immediate gain over a long-term one. So as we've had these sort of more immediate, more short-term, like the ability to sort of codify an understanding of how we create incentives and addiction centers in the brain around technology, it's much harder to get people to think about the longer term, and we all sort of fall subject to that. The second reason is decision-making overload. You've probably all experienced this day to day, but if you walk into a grocery store and look at the cereal aisle, the choices are just overwhelming. The number of choices of different types of cereal that you have can make it very difficult to figure out what it is you want. But that's not just true in cereal, it's true in a lot of the other places that we make decisions as well. And with the proliferation of technology, there isn't always a high barrier for ensuring that the information that you get is necessarily true, which can make it even harder to make decisions. And then finally, poverty has a very significant impact on stress. So there's a neural response where stress can limit your ability to make decisions for the long run. And the reason for that is, based in our core as humans for thousands and thousands of years. If you have something that's causing you a lot of stress and anxiety, maybe it's like a lion chasing you and you need to survive, you're really not thinking about the future, right? And so when you translate that into today's society, people who are struggling to be able to put food on the table really don't have the capacity to be thinking about, what the future looks like and how saving money can impact their future stability. So all of these things together make it very, very hard to change. And individuals have certainly tried different tactics, but I think really in the last 20 years or so is when we've started to talk about ways to affect this at a society level. And one of those ways is through behavioral economics. So if you've ever heard about this concept, it's a really neat form of science that sort of unites the psychology of the brain with the modeling around finances and economics. I want to give a really quick example because sometimes the easiest way to understand behavioral economics is to talk about like how we see it manifest in society. So if I were to say to each of you, you have an opportunity right now, I will give you $250. I will just give that to you. There's a 100% chance that you'll walk out of here with $250. Most of you would be pretty excited about that and think that would be a good choice to attend this webinar. Well, the second thing is that I could say to you, well, how about we spin this wheel and I'll give you $1,000, one out of every four things that this could land on, right? So a 25% chance of earning $1,000. You're probably excited about that too, right? That's, 25%, that's a pretty good chance. Well, in traditional economics models, there would be something called an indifference point about these two different items, right? And what the modeling says is that you as a person should care about those two opportunities exactly equally. Now, if I were to present these to you and say, which would you prefer? I seriously doubt that most of you would say you would take either one, right? That it literally didn't matter to you. Most of you would say that you preferred to just take $250, right? That's a decent amount of money. You can just walk away and be done. And so this is true, and we've run this experiment like across different cultures and across different societies, and the vast majority of people actually prefer the guarantee. And so this is a great example of what we learn in behavioral economics, which is that homo economicus is a myth. This idea that people make entirely rational decisions as if they were robots or machines is just not true. It's not how people think. It's not how they act. And it's certainly not something that allows us to create perfect modeling around how they make decisions. So I'm going to talk about a couple different biases and heuristics in behavioral economics, and then we'll talk about how they apply to savings. So on the left, you've got a really long list of a number of different things. We won't go through all of them, but I'll give a couple key examples, and we'll just talk about how they affect the brain. So the first one is called affect. So if I were to say food preservatives, are those good or bad? A lot of people would actually say that they're bad because they can think about the things that they do for food where there's sort of a downside. And the emotional response can often outweigh the positives just because there is a negative. Vaccines is another good example of this. Sometimes there are negative effects from a vaccine, even though it's a very, very, very small chance. People overreact emotionally to that negative rather than seeing sort of the positive as a whole. So anchoring, does the average person make more or less than $100,000 a year, and how much? Most people would know that the answer is less than $100,000 a year, but because I put the number 100,000 in front of you, you're more likely to have a higher answer. It works in both directions. I could equally say, like, is the average, does the average person make more or less than $10,000 a year? Even if you know the answer is more, your answer would sort of be anchored to that 10,000 number that I put in your brain. Anchoring is a very, very powerful way to change behavior, even just by listing a number before someone else gets a chance. This is something, by the way, if Innovation Women ever does a salary negotiation workshop, this is something that all women should know, that they should be the one to anchor because you can help drive the conversation by setting a higher anchor when you're negotiating for your own salary. So a little bit of an aside there. Forecasting. So how long will it take for you to finish that project at work? A fairly big project. The behavioral economics heuristic here is that we are all too optimistic. And even when we know that things are going to come up that we don't expect, and we say, oh, I put in a 2-week buffer because I know that there are some things I don't think about, what we know is that we still underestimate those things, and it takes longer than we think, even when we have experience knowing that it might take a long time. Inertia. So if your political party changed its priorities, would you re-register under a different party? Maybe eventually. It's kind of inconvenient. Does it really even matter? Inertia is also a very powerful heuristic. It is something that we all are sort of in the middle of our life, and if something comes up to try and change our behavior, it needs to be fairly powerful to get us to actually act differently, unless it's something that we consider very important. So the empathy gap. Would you steal food or rob someone to be able to feed your family? This is an interesting perspective because when you're in a rational state, some of these questions, you're like, well, no, I wouldn't do that. I don't steal from people. That's not who I am. But when you're talking about sort of a heated, emotional, or visceral state related to fear or anger, it can be much more difficult to make those sorts of rational decisions. And for people who aren't in that state, it's hard for them to understand why you've made the decisions that you have. So next, time discounting. If I gave you $100 now or $110 a month from now, which would you prefer? And it's not exactly a straight line, but for most people, you will overvalue things that you get immediately. Again, this is related to that short-term versus long-term perspective. If you've got something now, then you can utilize it now versus if you have to wait for it, it's not necessarily as valuable to you. Diversification bias. Sometimes people view more choice as better. So should you get a variety pack of something? People will often pick a variety pack even if they personally only like 1 or 2 flavors in it, just because they think, okay, well, I've got more choice, so that's better. Sometimes it is better to just get a bigger box of the thing that you like the most, but that's hard for people to overcome. The inequity aversion is similar to the guarantor that people like. So this idea of like, I would much rather have $250 as a guarantee. It can relate to equality as well. So if I said in your company, what if everyone got a $100 bonus? Or what if 50% of the people got a $200 bonus? Rationally, those are the same thing. And even if you think you're in the top 50%, you might not want to see that bonus structure come out. You'd almost rather see everyone get something. And then finally, social norms. So would you pay a family member who cooked a meal for you? Most of us would say no. I think I certainly wouldn't pay family members for cooking for me. It's sort of what you do as a family. There are a lot of examples for things that are different in different cultures. This is one that sort of fits across most cultures, but it's something that can affect different people differently in how they make decisions because they're used to how things operate in their specific culture. So when you look at all these different things, the reason that they matter is that they can make it very hard to understand what behavior is going to be. And I think even if you were asking yourself some of these questions, you may have noticed some things might cause a stronger reaction in you than others. So it's really important to note that these don't have the same effect in every person. Some people really don't like inequality, and so they're like, no, everyone needs to get the same thing, whereas other people have more of a tolerance for that. These different effects aren't necessarily mutually exclusive. They don't, they can act together and they can act on top of each other. They vary pretty dramatically, again, depending on where you are and who you're serving. And they aren't necessarily mathematically logical, but if you think about them and you think about how you would respond, they are often intuitive. And so when we talk about behavioral economics, there's a whole world of things that we're talking about that basically make up the effects that people have on how they make economic decisions for their own financial life. So we talk about this at Catch a lot. And we talk about like what can we do to actually improve things, knowing these factors about how people make decisions. So there's one key principle about behavioral economics that's basically used, across very different fields, but it's called a nudge. A nudge is basically positive reinforcement and indirect suggestions that are used to alter behavior. It sounds like a very textbook definition, because it is. But the important thing to know about a nudge is that it is a suggestion, right? It is something that is not mandated, but it allows people to be anchored or to sort of be directed towards the things that you want them to be directed to. And as I'm saying that, you might be thinking, okay, well, I've got some immediate concerns that come up about that. And so let's talk for 1 minute about what the ethics of nudge theory are. So the concern that a lot of people have here is that there can be some manipulation. So what if we're talking about people who are sort of being brainwashed or being directed to do things that are, for lack of a better word, bad? So you can think about how these sorts of principles might be used to encourage people to to drink more, or to purchase tobacco, or to spend their money on things that they don't need. And a lot of people believe that there's a pretty significant impact on the individual and on free will. And so when we think about nudge theory, we have to be aware of this manipulation and that this possible concern is something that could happen. And so what we do is we work with something called choice architecture. So choice architecture is the idea that what we're doing is we're trying to design the options that people have, and we're not necessarily forcing an outcome on someone, but we're providing a structure under which they can still make their own decisions. So what it means is that you want to limit overload. Again, we know that having too many choices can be really difficult for people, so you want to limit overload and be really thoughtful about what the default is that someone might choose, but allow people to have divergence from the things that you're suggesting, right? So one really good example of this is that, like in a cafeteria at a company or at a school, when you move the fruit, like the fresh fruit, the apples and the bananas, close to the register, and instead take the candy and put it sort of back in a corner, what you'll see is that the sales of fresh fruit goes up and the sales of candy goes down. So that's something where people still have a choice. They can choose to go get candy, but just by having that proximity to the register when people are leaving, you can affect the outcome of what happens for people. And this is all really important because of this sort of second to last bullet point on the choice architecture piece, which is agreed upon outcomes. And this is where it can get challenging to talk about, because you say, okay, well, what are the outcomes that we want for people? And for the work that I do, where do I have influence, and how do we start to think about like what outcomes are actually important? And so what the Catch point of view is, and we talk about this entire presentation was built by our team. We've talked about this a lot and how we think about it. But when we talk about choice architecture and the desired outcomes, we've taken a position that we will use these tools to drive outcomes that we think benefit the vast majorities of our users. So for people who are coming to the platform who don't have benefits, we will use nudges to help make it easier for them to save on outcomes that we agree on. But we also are very open around the discussion that needs to come around the nuance around balance and when and where and how those nudges are used, because it isn't always a very clear answer. Again, as we've talked about, different people react to these sorts of nudges differently or more strongly, and you certainly want to be aware that as people make decisions in their own lives, they need to have an ability to sort of opt out of things that aren't right for them. So At Catch, we've talked about a number of different outcomes that we as a team believe are good for our users. So they include things like saving more money, saving more frequently, investing more money, investing more often, automating that process, filing taxes properly, understanding jargon, and limiting choice overload. So those are all things that when we think about the individual pieces of our product, we look to try and optimize for because we think those are good for people. And again, we always have a conversation around like, where are the places that we need to allow people to opt out? Where are the places that we need to allow people to change how they structure their own arrangement in a flexible way that works for individuals? But as the product serves a large group of very different people, we do like to talk about like, what are we actually trying to do? And helping people save money is certainly one of the primary ones. So just to give 2 or 3 examples, all these things that you see on your screen are pieces of the Catch product or the Catch roadmap of things that we will be building for our users. So I wanted to talk about them so you can get a sense of how some of them can actually work in like a day-to-day fashion. So on the top left corner, you see something called the Plan Catch-Up. So one of the things that we do for our users who don't get employer benefits is we set up tax withholding for them. So for 1099 workers where taxes aren't taken out of your income with each paycheck, we can do that, right? We can connect to your bank account, and each time you get paid for a 1099, we can set aside a percentage of your income so that it's ready when you do actually file your taxes. One of the things that we added on this catch-up idea is that when you initially set up your account, we actually prompt you to sort of get started. And we say, why don't you set aside a little bit of money because we're partway into the quarter, we're partway into the year, and you already have some taxes accruing as you've earned income. And so we say, like, catch up and get moving now. And that small prompt is a nudge that we think, and what we've seen is that it helps people save more money. So when we added in that feature, we saw our users' balances in their tax accounts increase by about 25%. So that was an exciting way to help people accomplish that outcome that we know is beneficial, which is having more money saved. The second one is the guide. The guide is a feature that we use where we help people understand what the benefits landscape looks like. So beyond taxes and health insurance and retirement, there are a lot of other benefits that people talk about that we don't offer yet, but that you just want to get a sense of understanding. So, what is a 529 plan? How do I think about vision insurance? And so when we put the guide in place, we were very thoughtful around how to help people get started and how to limit choice overload. So we wanted to show people options, but we wanted to make sure it was all in a very contained way and make sure that they were also able to understand jargon. So again, moving them towards those outcomes that we've agreed are very good for people. And then finally, the paycheck percentage down here on the bottom left. One thing that we've done is that we take aside a % of each paycheck for the benefits you need most. That was a way for us to help improve automation, so helping people save automatically. What we know is that people are much more likely to save if they have to do less each time they need to save. So that's something that we've done to also help people save money more frequently. So those are just some examples. Again, I think there is a broad world where behavioral economics can help impact the way that we structure everything that we do. This isn't just in financial services. It can exist in how you manage assigning chores to your kids, or how you think about politics or community development within your own neighborhood. There are a lot of different places where you can start to put in place things that help guide people and be thoughtful about, what choices you're putting in front of individuals in a way that sort of drives a certain behavior. So the reason we do that at Catch is that we are trying to build a new personal safety net. That's what our mission is. We want one that is affordable and accessible and effective for everyone. And that's something that we sort of spend all day, every day talking about. So I did want to make sure I leave enough time for questions. I think we've got 10 or 15 minutes left. So I'm going to go ahead and cut over to questions now. I'm happy to talk about anything from what the Catch product does to how we think about savings and what that actually means to, personal questions about things you can do to get saving yourself. So thank you so much for joining today. I'm happy to answer any questions.
Great. Thank you, Kristen. That was really interesting. I especially liked the list of biases, and they really made sense to me and resonated with me. I hope others got a lot out of this as well. The idea for a salary negotiation workshop is a great one, so we We will think about doing that for our
yes.
numbers. We do have some questions coming in, so I will start and let others type in theirs, but I will start asking you. The first question is, are there examples of how people use behavioral economics for less positive outcomes?
Yeah. So again, you heard a large part of what we're doing at Catch is trying to be thoughtful around what are the outcomes that we actually want. I think it's probably fairly intuitive, but you can imagine that people who have businesses that are driven by outcomes that are not necessarily good for people. I think one great example is a lot of social media websites. They employ a lot of these techniques to sort of bring you back to the app and to have you spend more time in it. Now, some people might say that that's not necessarily a bad outcome, but I think what we've seen is that this idea, there's one really common principle in social media, which is called the infinite scroll. So the idea, when you go through Facebook, for example, Instagram is somewhat similar. When you go through Facebook, it's never ending, right? And it's not totally chronological. So there are things that happen further. And the whole reason they do that is because they want you to consume more of the advertising dollars that happen. And so that was a very intentional choice, right? Like they could very easily do something that Instagram does that is a little bit more beneficial for people's outcomes, is that they have something that says you're all caught up, right? Which tells you when you get to a point where it's like, okay, you've seen everything before this. That's not something that's actually better for Instagram because it makes you more likely to leave the app, but it is something that uses a much more ethical design process, recognizing that people, don't necessarily need to be driven to be in a social media app all day long.
Interesting. Another question came in that says, what can I individually do to get better at saving money?
Yeah. So this is a really tough question because I think, again, we talked about some of these societal things that are not necessarily working in your favor. So the number one thing is automation. Any way you can automate saving in your own life is the easiest thing to do to actually make sure you'll do it. And I know that feels hard, especially when you don't have a ton of money. But even if you're setting aside $5 every paycheck, making sure that you actually set some money aside in a savings account without having to think about it is the best place to get started. The second best thing you can do, which is still very powerful, is start to build the capability. And that's kind of an interesting concept, but when you think about going to the gym and lifting weights, you don't just walk in and pick up a 50-pound barbell and start, pumping iron with it, right? You start small and you work your way up. So practicing saving, working towards small goals, achieving those goals can certainly be helpful to sort of build the skill. I think saving money is definitely a skill, and automation, certainly, again, for the people that we serve, it can be very difficult because you earn very different amounts of money, and so you almost have to be better about building that capability and starting small and doing it regularly. I think it's very hard to save money when you just say, I'm going to do it once a year. It's much easier if it's sort of a habit that you get into, just like with everything else.
Yeah, that's what I was thinking. When you say automation, you mean habit, right?
Yes, that's exactly right.
Another question came in, and she says, thanks for a great presentation. Have you guys thought about adding a whole life option for retirement planning? Might be a great option for those who want more than a nudge as a forcing function to save every month.
Yeah, that's a great question. And I think, you saw when I started the presentation, we talked about 4 different pillars, but we focused on the savings and investment piece. I think the question around insurance is a really, really interesting one, and it's one that we want to talk more about with lots of different perspectives. I think one of our thoughts about insurance is that it can be difficult, like you said, for those who want more than a nudge. And we do hear from some of our users as well that they want it to be harder to touch their money. We set it aside in a liquid savings account. Some people are like, hey, I don't want to be able to access this. I need it to be out of touch. And so I think we're really interested in finding ways to do that, but we also want to be really thoughtful about where people can opt out of that. So I think whole life is a great way to do that. We've also talked about, various forms of annuities on sort of recreating this idea of retirement that's less of an investment product and more of an insurance product. Again, replicating pensions. or more sort of social safety net features that exist in other countries around the world. Something we're certainly interested in, but it is an ongoing conversation around how you do that responsibly for different sorts of users.
Okay, and speaking of retirement, another question is, when should I start saving for retirement?
Yesterday. The answer is always as soon as possible. And again, I know that can feel very challenging for people who don't necessarily feel like they have a lot of extra cash flow. But it is related to liquid savings as well, which is that the sooner you can start saving and you can start setting aside automatically, the easier it is to get used to that habit. And so again, the way that the Catch platform works, so we right now are working with IRA products. And what that means is that each time you get paid, whenever that is, whether you are a freelancer and you earn $10,000 once every, 2 months, or if you earn, $75 a day because you're driving for Uber or things like that, we set aside a percentage of each of those paychecks. And so we see a lot of users come in and they set aside 1%. Right? It's not necessarily a huge amount of money, and honestly, we do need to work on sort of escalating that percentage, but it's a start. And I think that's the thing that can sometimes feel overwhelming about retirement and long-term investment, is that you're like, okay, I need $1 million, and last year I saved 2,000. I'm not going to get there ever. It's going to take me hundreds of years, and I'm never going to get there. And I think that we need to work sort of as a society, and it's certainly something we think about at Catch, which is that making people feel good about starting small and about doing something and rewarding that and incentivizing that and making that a priority, because we, again, have 21% of people who have nothing saved, and then thinking about what are the steps we can do to help, increase and get people up to higher percentages and the right amount.
Right. Okay. Another question from the audience. We hear a lot about baby boomer and millennial savings and spending in the generational warfare article. What about Gen X, and are there any predictions for Gen Z?
Yeah, that's a great question, and I want to be careful because I don't want to say things sort of off the cuff. I think you're absolutely right, which is that baby boomers and millennials are written about a lot. They're sort of the larger generations on each side of Gen X. I think what we've seen is that the boomers are sort of the generation that had a blend of pension and 401k. I think Gen X is really the first generation that has been the vast majority have had just 401ks in their entire working life. And that's something that honestly I'm very concerned about, given what we know about savings rates. 401ks were not meant to be an alternative to pensions. They were meant to, we sort of scaled off of pensions without really recognizing whether or not the 401k was an appropriate substitute. And so I think Gen X has an interesting challenge because their retirement is going to be they're the first generation who haven't, en masse had access to these products that are guaranteed income, like a pension. So in terms of predictions for Gen Z, the only data I have around that right now is around their preference for debit versus credit, which is just sort of an interesting factoid, which is that they are much less trusting of credit than older generations, which sort of makes sense. I mean, millennials sort of split the difference on the financial crisis, but again, I think as student debt becomes a larger problem, Gen Z is very focused on cash and debit and not utilizing credit more than they need to, which I think is in some ways it's good because you certainly don't want people who are, over leveraged on debt. But in other ways, credit is actually a very important tool. And building credit over time is something that actually allows you to accumulate wealth in various ways, like a mortgage, for example. And I think it's something that we do need to think about as Gen Z emerges. The cash preference in the immediate transaction is not necessarily something that will suit them for the long term. But ultimately, across those four generations, I think the biggest thing that we see is that there are sort of societal and infrastructure changes that need to happen more than any given individual behavior change will upend the system.
Yeah, that's really interesting. Another question from the audience. I am a freelancer and don't earn consistent paychecks. What should I do to save?
Yeah, use Catch. Definitely my first recommendation. But I actually do think there are a lot of really great savings tools out there. Again, Catch is focused on benefits. So we do tax withholding, we do retirement, we do health insurance. There are a lot of tools out there that can start to build capability around more just goal setting savings. I think Acorns is a great tool. I think they have a really nice interface. Stash is another good savings tool. There are lots of options, but one of the things that we've really tried to be thoughtful about with Catch is the fact that, as a freelancer, your income isn't always predictable. And so again, allowing you to set aside whenever you get paid, however frequently, is something that we think is a really powerful way to help you save without having to think about it. I think one thing I'll add is that a lot of times stable W-2 workers, often, we talked about the empathy gap as one of those heuristics. The empathy gap is very strong between W-2 workers and 1099 workers, meaning that it's hard for a W-2 worker to understand why freelancers can't save, because they sort of take for granted that they have those second order products being taken care of by someone else, right? The fact that your HR department sets aside in your 401k with each paycheck means that you have this stability sort of baked into your life. And so, I think there is certainly a gap in terms of how people understand that. And when you're actually living the life of like, this is so great, like you get the highs of highs as a freelancer where you're like, I just got a $50,000, payment from a client. But then it's like, yeah, but you spent like 6 months eating ramen to be able to get there. And that volatility can be really difficult to manage. So again, back to the other advice of like what to do to start saving. As much as you can automate and set up so that you don't have to manage it day to day, the more likely you are to be successful in meeting those goals.
Okay, and I think you just answered the question. One of the last question we have here is, are there good tools to use for saving?
Yeah. I like Acorns and Stash. I think those are great. I think even within some of the banking tools now, I haven't used them. Personal point of view, not speaking for the company, I find like I use Bank of America. Their interface is challenging for me. There's just like a lot going on. I know they've tried to put some savings tools in place. I think that can certainly work for some people. But I think the general advice, again, back to people who are earning a more volatile income or earning 1099 income on the side, being able to separate your finances is really important, and being able to like create those buckets. There's sort of this mental property that money is not entirely fungible. Which means what that means basically is like when you put money into a separate account and you're like, this is my account for X, even just doing that can be really helpful in like helping you not actually overspend, because you're like, no, that's what this money is for. It's for my taxes. Like I'm not supposed to touch that. But I think that separating out your money into the big buckets you need is really helpful. And direct deposit, by the way, like every payroll company out there has the ability to split direct deposit. So if you haven't done that, it's a little bit of work to set up, but then once it's set up, you have it done for you with every paycheck so that it goes into the different buckets that you need most.
Excellent. Yeah, that's great. Good tips there. And I think we're out of questions from the audience, but we have a slide up that shows Kristen's email. If you want to connect with Kristen through email, that's where you can reach her. And be sure to submit your feedback online in the feedback rate this webinar section. Be happy to take your feedback and modify any part of the program that you guys suggest. I will push out the link to the next webinar in 1 second, and use that to register for the next webinar, which is in 2 weeks. And other than that, I think we are out of time and out of questions. So thank you, Kristen, for your very enlightening presentation. And,
of course. Thanks, everyone.
We will sign off, and have a good day.
Thank you.